Hello traders, hello everyone. Welcome here in the beginners room at Live Education with XM, and also welcome YouTube. We're gonna have this entry exit strategies session. We're gonna discuss basics of entering and exiting the market, what's important and why, and what is important also that we will not mention here in the session. So of course, if you want to follow us from YouTube, we're going to be 15 minutes on YouTube. If you want to follow us to Live Education, XM Live Education, then of course you are more than welcome. Feel free to use the chat as well. I hope my stream operator gonna send me also your comments from YouTube, and we're gonna be addressing all the questions, thoughts, ideas you want to share in the chat. Of course, anything that gonna be anything that's going to be unclear, please let me know. We're going to explain it more deeply. Keep in mind it's a beginner's room, so it's fine also with beginner questions, or if you feel like question is too trivial, that's not a problem. You are more than free to ask, more than welcome to ask. We're going to explain. So basically, we're going to go through a structure of entry-exit strategy. Entry-exit strategy kind of forces us to focus on charts, okay? So psychological aspects, money management aspects, and fundamental aspects of trading strategy, they are important. They have the right place for a trading strategy, but they are not for entry-exit. Basically, we're going to focus on charts. So they're going to be left aside, but that doesn't mean they are not important. They are extremely important, okay? So keep that in mind. In this session, we're going to focus on charts, because whenever you want to enter the market or exit from the market, we're going to be looking for optimal place or optimal timing to do so. Ideally, time and place, but by place I mean price level. And oftentimes timing is more important than the price level, okay? So this is also important to understand. So we're going to look at a simple structure, yet effective, right? How entry-exit strategy, what are main components of entry-exit, or key components of entry-exit strategy, how they can be solved in a few different ways. As I mentioned, chat is yours. Of course, feel free to use it whenever you need. Basically, what is very important to mention at the beginning, so to get the right mindset in trading, predicting what the market going to do is very tempting. Knowing the future is not only a desire of traders, but every trader that steps into trading feels like, if I only knew where the market going to go next, I would be making money without any problem, okay? So like the whole fortune telling profession, you know, all those gypsies that were telling the future from, you know, like different items, different artifacts, like crystal ball, for example, or like some bones, whatever, from your hand, from your palm, right, telling the future, they were always having business, right? Because and it's not only about trading, like people in general want to know the future. They feel like they're going to master life when they learn how to know the future, right? So it's very tempting to try and predict what's going to happen and try to be good at predicting. Unfortunately, in trading, it does not work, okay? You're going to be sometimes better, sometimes worse at predicting in terms of how well you're going to be predicting things, but it will not be consistent, most likely. And at best, it will be 50-50. But in trading, trading is not exactly 50-50 because there is also a volatility component, okay? So market does not only go up and down, but sometimes goes sideways by moving up and down, but with different width of those moves. Okay, so when you have to put an order and manage risk, it's not actually only up and down. It's not exactly 50-50. Hello, Yanis. I'm seeing Yanis with us. Thank you for joining. Thank you for joining the chat here at Live Education Room. So we will try avoid predicting. There is like if we want to, we can turn this into anticipating. Okay, anticipating. And well, I made a mistake. Anticipating. So the difference is predicting for profiting is essentially not working well, but anticipating, let's say, possibilities or scenarios is helpful in managing risk. Okay, so essentially, if you take beginner trader will want to predict what's going to happen next, and if he's confident about knowing what's going to happen next, he thinks he knows what's going to happen next, he ignores other possibilities. So then he has a lot of problem on the risk management side. Essentially, risk management is either non-existent or very crippled when beginners are trading, because they don't look at possibilities. Maybe there is too little experience also, right? Like experience is what have hit you in the past that now you are aware that you can get hit from different sides, different angles if you have enough experience, right? So in that sense, you either learn risk management the hard way, right? Usually we learn the hard way. I also learned it the hard way, right? They say expert is the person that that made all the mistakes out there, right? So you make mistakes, you learn, and you gain experience, and then you know what to expect. So anticipating is not like predicting and going for it to make money and neglecting risk management. Anticipating is actually for, okay, I'm having something that I want to speculate on, but then there are also other possibilities that I see. I have to protect against them, right? So this is important, not to confuse those things. So we don't want to be predicting. So the assumption is we don't, basically very direct assumption or very direct conclusion from that is, if I can't predict, how do I trade, right? Like that's the big question that I asked myself many years ago. Like, okay, if I'm bad at predicting tops and bottoms, how do I trade? And so we have to find a way to trade when we know that we are bad at predicting tops and bottoms. Okay, we cannot predict well, and so we don't pick tops and bottoms. Okay, so we start avoiding selling low, buying lows or selling highs. All right, and so essentially, if we take a swing, if I take the swing, I'm not gonna be buying it here, and I'm not gonna be, well, assuming that's the like some significant top of the swing, I'm not going to be selling the very top of the swing. Okay, not going to try to pick it up. Meaning, if we are going down, I'm not going to be buying. Okay, if we are going up, I'm not going to be selling. This is one very important rule for me in terms of entry. Okay, the same, even if I see there is a downtrend before, right? I'm not going to be selling once we are going back up, correcting it, or you know, relieving from that downswing. Okay, I don't want to sell it. Now, then there is another problem that trader is, well, trader who's trying to get more advanced and trying to get more conscious in trading. So he says, okay, I'm not going to sell the top and I'm not going to buy the bottom. So I want to follow trend, right? I think if it's going down, it's going to continue, right? That's what's left, right? The middle of the swing is left for me, and I want to trade with the trend. Personally, well, as a swing trader, I'm calling it, I go with tendency. Like, okay, it's better to have a trend, but it can be tendency for other reason, right? Some people call it minor trend. If it's correction, some people call it minor trend, okay? For me, it's just tendency, okay? So we are having a tendency that's being continued until it's broken, right? Until it's not. And so we are left with this middle ground, with this middle section, let's say, okay? Or in a sense, of course, I'm not gonna buy it here, but many traders, what happens to them, they sell late, okay? So they sell here, for example, because they are seeing tendency, like the tendency is the most mature when it's the most visible, okay? Some tendencies are very visible and they continue, but this is not very often on the market, okay? And it's happening on rather more volatile markets or in more volatile periods, which mean that the rebound and the comeback is very sharp, okay? So the moment the tendency is very visible, right? And the more visible it is, the more appealing it is. People like to enter, like sell, okay? So they chase it in a sense. They chase it, and what happens is that they either sell the very low, and that's common experience myself as well, for myself. It's been in the past, and or they make money initially, and if they don't take profits, they see market coming back for their stop loss, for their break even. They see market coming back, taking away their profit. But this happens on volatile market, okay? On not very volatile, very regular, in very regular situations, they usually see the swing is, or the tendency is visible, meaning it's mature, meaning when they chase it and try to sell, right? Because it feels that it will only go down, right? And it's going down so fast, and I'm missing profits from shorting it, that I have to sell and join it, right? And then later on, price goes sharply against me. That's what volatility is bringing. Okay, so this is not optimal to be selling here. Like if you think about that swing, and if we slice it into sections, right? Let's say I'm not selling around the top, not trading around the top, essentially here. And well, you can say, well, this is history, so you clearly see how big the swing is, and in general. So we're gonna try to figure out the framework on this example. If that swing was meant to be like this, okay? I don't know what this swing gonna be, but if I'm ready to speculate about it, and I want to speculate about, and I think it's worth it, I open position. I want to have a framework if it's gonna be a big swing, right? I want to have this framework in place. I'm speculating about it to be the swing that's gonna bring enough reward. Otherwise, if I don't believe that, if I don't have reasons to believe that, I would just not open the trade. So based on that swing, we can use it as an example and figure out what would be the framework, okay, for the next swing that we're going to be trading. So yeah, basically, I don't want to sell the very top. And then after the swing is advanced, right? Like, for example, I had a pullback. I have a test of that previous low. I have continuation. The more we go for the next low, the more advanced we are, right? The more there are a few ways how you can calculate that, but this is not critical. This is more about the framework, more about general idea. So I'm assuming if I'm seeing the top, meaning that we are already, for example, testing previous low, right? to maybe make this example simpler, right? We don't know when correction ends. So I'm seeing impulse and I'm seeing we are correcting impulse, right? Until certain moment, okay? Like price rebounds, and the rebound is big enough to tell me, oh, okay, so that's the bottom. It may be 25% of the pullback, maybe 50% of the pullback, maybe maybe retest of previous high. Okay, so then, oh, okay, so that's the low, right?